Hey everybody, Jason Sherman here. In today's episode of Zero to CEO, I speak with entrepreneur, investor, and Evolution Co-Founder Alex Chompff. Welcome to the show.
Thank you very much. I really appreciate the opportunity to connect with your community. Thank you.
Definitely. And today's episode, we're covering venture capital with a purpose and impact. And this is, there's so much stuff going on in the news that I'm reading on a regular basis. Like, is it okay to raise now? Is it harder to raise now? I've even seen this term seed strapping, where people are raising a seed round and then they're not raising after that. They're trying to make the seed round really work for them to the point where they earn enough revenue to become profitable so they don't have to raise. I'm kind of thinking the same thing. Like, everyone knows me. I'm running an AI startup right now. We have revenue, we have traction, we have a good team, we have a great technology. People are using it, customers are using it. And yet it's still hard to raise money. So, I guess what I want to ask you as the first question would be, why is it so hard to raise money now rather than what it was 10 to 20 years ago when investors were throwing money at the wall and hoping it would stick? Now it's like they want to see like more and more and more to mitigate their risk.
Yeah, this is a very good question. And the first thing, of course, to understand is that investors, particularly early stage investors, which is what we're talking about here, they're very human. They're very human. And so there's wide variability among humans, and there's wide variability among investors. And it's important to distinguish between a couple of different basic kinds of investors. There are investors who invest their own money, and then the cost of not investing is actually very, very low. Right. And then there are investors who invest other people's money, and the cost of not investing is actually significantly higher because of a key metric called the internal rate of return, which degrades from the time you take the money in until you make your return. So it can be very helpful to understand, where the human is that you're talking to in terms of their own inclination and their own risk and reward. And then also to understand, like today, as we're recording this in April of 2025, macroeconomic conditions are very unsettled. And as a result, people more or less sit on their hands when there's a lot of risk and uncertainty. And people are starting now to come off the sidelines, even going into May. I think we're starting to see some, early penguins off the ice floe.
Yeah, and
we'll see if the sharks eat them or not.
Yeah. Sharks. I mean, you said that's what, I always watch Shark Tank and I equate investors with Shark Tank being ruthless in some ways, but I've talked to and have found some really nice investors who believe in what you're building. I think the misconception, maybe the disconnect that I'm finding out there is the founders who raise millions of dollars without a product built versus the team like ours who has a 10-person team. We've built a fantastic product. We have, 100 customers. We have thousands in revenue a month. And yet we can't raise versus the guys who don't have a product built, don't have customers, but they have the cred because they graduated from Stanford or they worked at Google. And we see that as kind of like an unfair game out there. And got to, don't hate the player, hate the game. But what do you have to say about that style of investing?
Yeah. Well, okay, so let's talk about venture capital investing in particular. Okay, let's just focus on a narrow subsection of investing. And venture capital investing is, only about 70 years old, right? As an industry, 70 years old. And that's if you go all the way back to the original, guys who left Shockley and formed that first, competitor in the Valley. So, what are you on the fourth generation, maybe fifth generation? And so in the first two generations, it would have been individuals like you who would have been more likely to get funded because it was much more common. When I came, for example, when I was first introduced to venture capital in the late 90s through one of the venerable institutions, most of the entrepreneurs that were funded, I would say, were professionals with children, with wives, with families who had built careers and had come up with an idea and now needed capital to see that idea through to fruition. My early investors included my early clients included the investors in Google. And Google sort of replaced that early infrastructure intensive model by making Gmail available for free or
Right.
$5. And now anybody could start a business and get going in the internet era. And then it became, more about the, let's say, college type kids who had a certain pedigree, and they were really characterized by a few early pioneers in the social media space.
Right.
Investors being human, they tend to follow what looks like has been successful. And the real key to venture capital investing, of course, is not to follow, but to lead, understand what's coming.
And that's exactly what I want to ask you. You just brought up, this is the burning question everyone asks me. If VCs are investing in the sure thing, at least in their mind's eye, the guy worked at Facebook, PayPal, Google, Airbnb, he was an executive, he was a coder, whatever, but then he's not giving a chance, or she's not giving a chance to those who they don't know if it's going to succeed because they haven't given them a shot. How does a founder break through that wall? Because it seems to be a pretty big wall where investors will say, come back in 6 months when you have more revenue, come back in 6 months when you have this. But we're breaking through the mold as opposed to the founders who don't have a product built, and it's very confusing.
Yeah, this is a fantastic question because it points to the segmentation even within the industry. So VC is used to describe a large range of behaviors, from the very earliest of early stage investors, which is, for example, what we are at Evolution. We're so early at Evolution that we're always pre-profit. We may be pre-product. We have been pre-formation, right? It's very
interesting. So just a napkin with a drawing on it, and that's it.
That's it. That's it, right? I've even had some deals come through where I've known an individual for years, and I've said, when you're ready, let me know. And my number one, I want to be your number one check.
That makes sense too. So it's like a relationship that you formed over time, and the person said, okay, I think I have something here. Let's work on it.
That's right. And so when you invest where I do typically, and where my colleagues do, then it's very much relationship based. It's highly personalized. Now, what you're describing are behaviors that are associated typically with later stage investors who have certain thresholds that they have to meet. You have to have $1 million in revenue. You have to have $2 million in revenue. You have to have, a certain broadness of your client base. You have to have, concentration has to be low in your customers so that your risk profile. Those are later stage investors, and later stage investors have different priorities than early stage investors. So if you're having that conversation, you're talking to the wrong investors.
Right. And we've noticed that. So we've been targeting the, early stage investors, and believe it or not, we're still hearing similar statements from early stage investors, even though they say their checks are smaller, they don't need any revenue. And we're like, well, we do have revenue. We do have, it's not a ton, but it's enough that it's almost breaking even on our operational expenses, which to us is huge. And so we're trying to identify, and I guess that's the main question that people have. Like, how do I identify the right investor for the stage that we're at, the traction that we're at? And keep in mind, one thing, Alex, is that one of the biggest issues or challenges with startups is they reach a certain moment in their company, and you probably know this already, is they reach a moment where they say, okay, I've built a product, my team is solid, I have traction, customers, and revenue, but I can't grow anymore without a higher ad budget, or without extra salespeople, or without this and that, and that's where we're at. We're stuck at a very, small ad budget of like $50 a day. We'd like to make that $500 a day because we know that it works. We know that we're able to get more customers. So we need an investor to believe in us and say, okay, you guys already know what you're doing. Here's the fuel you need to make the fire go higher. And that's what I always teach is to scale, you have to build it to the point where it's ready to take off. And then when you get the money, you're just taking off. You're not learning anything. You're not building anything. You're just putting fuel on the fire. So talk about that for a little bit.
Yeah. So, the amounts that you're describing in this conversation, Jason, lead me to believe that you would probably be better with an angel investor as opposed to an institutional investor. Institutional investors, remember we talked in the very beginning, are you investing your own money or are you investing somebody else's money? And there's a very common misconception that angels write small checks and VCs write big checks, and that's just the way it is. in reality, VCs are managing other people's money according to a thesis. And they'll tell you their thesis because they want to save their time and they want to save your time. Right? Now, I will pause for a moment and just say to all of your listeners
Mm-hmm.
that there's really very few kinds of capital that are more expensive than investors.
Yeah.
To raise money is not in and of itself a meritorious act in my mind, at least not commercially. Okay. To earn money is a meritorious act. To raise money is not. Okay. To raise money is to accept the most expensive kind of debt that you possibly can, and to get married for a lifetime to someone who has expectations that can only be called high.
Well, let's talk about ethical venture capital, because that's kind of your thesis, right? What does that mean to you?
Yeah, well, to be more specific, my general thinking is that capitalism, which is a tool that we humans have created, ought to be used for our benefit.
Mm-hmm.
And when we use it, we ought to use it mindfully, and we ought to use it with intent and with clarity of purpose beyond simply economic purpose.
Mm-hmm.
And so ethical capitalism is something that I really believe in and think that we should all be practicing, because if we want this tool to continue working for us, then we need to use this tool wisely, just like we use our automobiles wisely, or we use our credit cards wisely, or we use any other kind of tool wisely. Capitalism is a tool that we've invented. And so this is, by the way, not something that I've invented as an idea. I'm standing on the shoulders of giants. Right. I'm just hoping to push the message a little further out into the universe.
Yeah. We appreciate that too. I mean, and you've had a pretty vast kind of background. I mean, you were at Kleiner Perkins. Everyone knows that company during the .com boom, which is pretty cool. Any fun stories about that time period? Well, I'm sure you have more than one.
The first thing you have to understand, because it's very easy to misunderstand, is that I was not on the investment team at Kleiner Perkins. I was their director of technology.
Hey, that's a pretty big title during the .com boom.
and they had this thing called an incubation space, which was a pretty novel idea. And I was fortunate enough to be given some supervision over that space. So
that's pretty cool.
I was very fortunate. I often think of my life as like a Forrest Gump moment. You know how Forrest Gump is in a lot of movies, famous events, but they're not really about him. He's just standing.
He's just there. Yeah.
Yeah, I'm like that. My primary skill at that age was that, having come out of the military, I could stand up straight. I could say yes, sir, with a great deal of conviction. I could show up early. These were marketable skills in 1999.
So you saw a lot. You saw a lot of things, and you mentioned incubation. I mean, I had a startup in 2014 that graduated from an accelerator in New York, so I know a lot about the accelerators. Is that something that you feel as though startups should look into? Or should they try to go it alone? What are your thoughts on accelerators?
Generally, I'm positive. Okay. Generally, I'm positive. I actually started Evolution as an accelerator. I found the accelerator model is pretty tough. It's a tough model. It's very tough. It's very friction-filled, very difficult model to execute on. And so I went to a different kind of model, which has now led us more into direct venture capital.
Okay.
But yeah, it's more efficient, and it functions a little bit easier for what I'm trying to do in my lifestyle. But the general answer is, nobody is born with the knowledge of how to bring a product to market, how to hire the right people, right? Nobody is born with all of the relationships that they're going to need to create a successful company, and no company is truly an island. If it is, it's an island in an archipelago. Like you really, your company doesn't mean anything if you're not buying and selling and hiring and
right.
What is it? And so
100%.
these relationships, I think, are some of the most valuable things that come out of those. Sure, accelerator, incubator, local business community, startup. There's a group near us called Startup Sacramento that has helped so many hundreds, maybe thousands of entrepreneurs get started, and they do it so selflessly.
Yeah.
That I can't recommend that kind of thing enough. Plus, if you're really an entrepreneur, then some point in your life you realized you were kind of a bird of an odd feather.
Yeah,
You weren't necessarily
absolutely.
like everyone else. Yeah,
Kind of
that's
an
just
outcast and a misfit. That's what we all are, right? And
yeah.
we have Philly startup leaders here, kind of similar. And Philly Tech Week is coming up this week, and so we kind of do a lot of that stuff here. And it's the best time to like network and meet your peers and just talk about your idea and hear other people's ideas and maybe collaborate with people. And so I definitely appreciate that as well. And if people think that maybe you are a good fit for them and they like your philosophy behind things, how could they get in touch with you and possibly work with you?
We would be honored and humbled beyond words if you thought that you might want to share your idea with us. We would be deeply gratified by that choice. And we're pretty easy to find. You can look for Evolution Accelerator on Google and you'll find us. If you're particularly interested in fundraising, I'll send you to one of our communities of interest, which is evolutionaccelerator.co. Sign up there to understand some of the science behind fundraising. And we run communities of interest for artificial intelligence at Masterverse, and for funders who are looking to understand how to access this asset class, we run evfm.co. And so we've been around a little while. We know a few people. We're here to serve and help.
I bet.
Since
the .com boom.
Well, again, I had the good luck.
You were the Forrest Gump.
Yeah, I was in the neighborhood and I needed a job, honestly.
Very cool. Very cool, Alex. Guys, check out evolutionaccelerator.co or evolutionacceleration.com. Alex is on LinkedIn. Connect with him. I know I will. And hope you guys enjoyed the episode, and we'll see you in the next one. Have a good one.